Is it time to get aggressive on risk assets? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Mark Ritchie, the second CIO of RTM Capital Advisors, who's going to walk us through this market breakout that we've seen. And we've asked Andreas to join us as well at the top to get some reaction to the rate decisions by the European Central Bank and the Bank of England. We've got a lot going on. Hi to both of you.
Hi, Maggie.
Happy Groundhog Day, guys. Glad to be here.
Oh, yeah. We forgot to add that to the list of things going on. I've been so busy, I haven't even paid attention. But Mark, you're going to give us the technicals on. I found out there's not just Puxatawny Phil, by the way. There's like a whole bunch of them. They all have their own sort of identities. So you'll give us the lowdown on that forecast as well. But before I talk to either of you, I just do want to put a programming note out there. At the top of the next hour, at 5 o'clock, Raul is going to do an AMA right here on the YouTube channel. So you can bet he has a lot to say about what's going on. So get those questions ready. Again, that's at the top of the hour, 5 p.m. Eastern, right here on the YouTube channel. So, Andreas, let's start with you. We had the Fed first this week. Now, rate hikes from the ECB, the BOE. They're still talking about inflation, but stocks are in rally mode. What's going on?
It almost felt like these three central banks coordinated the message this week. I have to admit that after watching all three press conferences. First of all, yesterday, the Fed clearly opened the door for a pause rhetorically by saying that they now sort of monitor the extent of hike needed. And it was basically a copy paste from Bank of England today with an actual pause in the press release and in the communication from Andrew Bailey. And then the European Central Bank took stage, and I was like, no, she cannot do that as well after she was so hawkish in December. And yet she did. She opened the door rhetorically for a pause. So I think this is about as green a light you can get from central banks to buy stocks with an arm and a leg.
Yeah. So, Andreas, if they, and I'm with you, I'm sure, I can never believe that these people are at the same place and they're not going to have, that's what the purpose of those type of, events are, like Davos. But do you think that if they're saying that, having pivoted from insisting that they're so hawkish that they're going to see inflation through to the end, although Powell's still mixing some of that rhetoric in, that leads me to believe, what do they know? What do they see that we don't? Wouldn't that mean that they are getting really concerned about perhaps how slow things will get or the lag effect of the policy they've put into place? Why would risk assets be rallying in the face of that?
Well, I guess you're right that they are concerned. The issue is that we don't have the data backing it up yet. Rather the contrary, at least if we look at Europe and other countries with a clear link to the Chinese reopening, we have improving data right now. And it's kind of a puzzle to me how the European Central Bank can conclude that things are worse than 2 months ago. They are obviously not. Inflation is falling on a monthly basis in many European countries. The economy is rebounding. The consumer is late Q4 last year. So it's kind of a puzzle to me how the European Central Bank ended up concluding that. The issue here is probably that the Federal Reserve has dictated this global trend in central banks. I would assume that Jay Powell behind the scenes orchestrated this message to global markets since he's scared of the US market. But I wouldn't find it fair to assume that the European economy is losing steam right now. Rather, the contrary is the case.
Yeah. And there are certainly we are seeing data slow down, but there are more and more people, it seems, who are willing to entertain the idea of a soft landing, even here in the US. Even though many said, listen, the Fed's track record on this is terrible. It's very difficult for them to manage something like that. At the beginning of the year, we heard more people giving it, at least entertaining the idea. What are your thoughts about that?
Well, I guess we had a soft landing in 2019, actually, after the Fed pivoted just ahead of New Year's in 2018. So it is possible. We also have a couple of soft landings to look back at in the 1990s and prior to that. So it's not impossible. Let's just put it like that. And I guess the issue right now is that as long as the Fed communicates that they don't intend to hike interest rates more than maybe once or twice from here, and inflation is waning, consumers are regaining purchasing power, etc., then the market is at least free to speculate in the soft landing. All of the good old recession indicators are still flashing red, but it's just very tricky to find a trigger for that recession when everybody agrees on it already. That is one of the things that I've highlighted over and over through the course of January. When everybody agrees on a recession, everybody has planned for the recession already.
Mhm.
So what is the trigger then? I don't really see it right now.
That really echoes. We had on Francis, who covers small caps for Royce, Francis Gannon, and he said he's out in the field talking to management at small and mid-sized companies, and he said the same exact thing. They've been braced for it so long, they've already planned for it, they've already put aside contingency plans. It's sort of in their minds, has happened already. So that is an interesting point. Andreas, so we see this rally going on. I mean, what a January this has been. Does that make it more complicated for the Federal Reserve and the central banks? I mean, aren't financial conditions working against them at this point?
Well, yes, but Powell was basically offered the opportunity to strike back on loose financial conditions. And then he started rambling about some other index of financial conditions than the one that we watch from Goldman Sachs. So he was offered the opportunity. He blew it completely if he wanted to take it. And unless the Federal Reserve becomes vocal in coming weeks, I would assume that they now deliberately blew it.
Yeah, and it was delivered to him on a silver platter. So
Hmm.
it's not, you can't believe he blew it without,
No,
accidentally. I mean, if he wanted to respond to that, and he has in the past, he absolutely would have. So he did maybe an awkward sidestep, but he definitely punted on that one. So Andreas, as you're looking at this, what's the sense in terms of this rally that we're seeing, and it's whether it has legs or not? Many people had been concerned to jump in the beginning of the year because they've been so burned by bear market
hmm.
rallies. You had been caught by that. Does this feel different?
It does to a certain extent, since we don't have the headwind from central banks relative to the bear market rallies we saw last year. Last year, every time equity started rallying, Powell took the wires and said, please don't take excess risk. He was very clear in his communication around that last year, but he wasn't yesterday. And I think that's a game changer, at least from a semantic perspective. And obviously, right now, there is nothing in the way for a continued rally, at least until we get confirmation from the real economic data that the economy is actually deteriorating. And I'm still waiting, and I wouldn't assume that we get any confirmation of a recession until the second half of the year.
Wow. All right, Andrea. So, and I know you're tracking all of this really closely in Steno signals, which you're dropping weekly. So we're going to pay close attention to that because you got your finger on the pulse of a lot of really interesting indicators, including some of the liquidity stuff that you've been looking at. So we're going to track that. Andreas, thank you so much. We appreciate it.
Thanks,
I,
Maggie.
s- I see some good questions coming in. So keep them coming and we'll get to them for Mark as we move along in the discussion. So, Mark, we had Andreas sort of paint us a very clear picture of some of the fundamentals that are driving this. From your perspective and the way you approach the markets, how does this feel to you? I'm going to ask you the same question, kind of picking up on the one we started the show with. Is it time to pile into risk assets? Does this feel different and real this time and not just a bear market trap?
The short answer is yes and maybe in terms of, so yes, it feels different. I'll get into exactly what I'm looking at and why. And in terms of do we just go head over heels piling into risk assets, that's sort of the maybe. And never in my process would I don't have an all in out all out mentality ever. And you want to be tactical, at least according to my philosophy. But taking a look back, and if you remember, Maggie, when we were talking all the way back in 21, as the year was going on, I was getting increasingly more cautious.
Mm-hmm.
And this is an important note on process, because it's sort of one of the things I see people often doing is they cement a view, and then they try and grab other data points and things like that to create a process really around their view. And mine couldn't be more opposite,
Mm-hmm.
meaning you run through the process and let that inform your risk management and portfolio allocation decisions, regardless of your opinion and how you feel. Um, People may not like that, but that's how I do it. How we
Yeah.
do it, here at RTM. And so I would start by saying, listen, what we talked about in 21 was a market that continued to lose strength within the herd. I've talked about this a number of times, but it's important because I think it was the last time you and I were on and spoke
Mm-hmm.
together. I said, listen, that dynamic is starting to go the other way. We're starting to see potential bullish divergence. This was late last year, where the market is at the lows, but the percentage of stocks below their long-term averages is actually improving, which is saying that the larger universe is actually potentially healing, if you will, under the surface of the market. And then if you look at what topped last, because a lot of people even asked in 21, well, why isn't the market rolling over? Why isn't it rolling over if you're so cautious? And by the end, myself, Mark Minervini, a number of folks in sort of the same school were saying, listen, you've got so few stocks in the averages that are actually still in long-term uptrends that I don't think this can possibly survive without at least a larger correction.
Mm.
And now we're seeing the same reverse dynamic. Furthermore, our proprietary risk model on January 13th at Minervini Private Access flashed the first buy signal since November of 21. So, and that, when people want to know, well, what do I look at? That's been one of the major guiding lights in terms of where is the larger wind in the market. And it was on a sell all last year. Well, why did it change? So let's go under
Yeah,
the hood.
let's talk about it. Yeah,
Yeah, let's
pick up
get under
that
the
hood.
hood to say
Wait, before
what.
you do that, I wanted to make two quick points. Some great questions coming in. I'm going to try to bring them in as we're going, but I know when you're saying get your framework really and let that guide your opinion. Don't decide ahead of time. I'm really thinking about some of the earnings that are coming out. We've got big ones after the close today. We've seen a huge move in ARC today, and we know how, so we know people feel very strongly about um, mega cap tech, or whether or Kathy's funds. So, if you come to it with a preconceived notion, I know that's what you're talking about. Open your mind and let some of the data points guide you. And then I just want to squeeze in a quick question from Doug Morley. Hi, Mark. Are you trading in these volatile markets or sitting on the sideline? It sounds like what you're telling us, you're trading these markets.
I am longer than I've been in probably over a year. Now that may change in either direction, meaning I may get a lot longer in coming weeks, and I may raise a lot more cash if I don't like the price action. And this is precisely how I've always done it. Meaning, so back to the prior point, stick to the process. And I didn't finish up the point saying, in the end of 21, the reason the percentage of participation was continuing to deteriorate was it was the mega caps that were holding their heads above water while everything else was drowning. And unless you were looking under the surface, you didn't see that. When they rolled over, that's when the indexes finally really cracked. And if you saw at the end of last year, it was the opposite dynamic. The mega cap tech names that were so big, the Teslas, Apples, Amazons, were trading really poorly, making, in some cases, new 52-week lows, while the rest of the stocks in the averages were not. And I'm saying that was a potential tell. So now, remind me what the question was.
Yeah, so now
am I getting involved?
Yeah, and you said yes, you've been longer
Yes.
than you have been, but importantly pointed out that your time horizon is always on the shorter side. You're very tactical in your approach.
This
So
is
just
where,
take that
yeah,
into
my
account,
philosophy
right?
is more trade to invest. People ask me all the time,
Yeah.
are you an investor or a trader? I go, well, both. But look, I want to finance my investments with gains up front. Why do I want to buy something, then have it go painfully against me and go, let's buy more? That's illogical to me. I'm not. Listen, I understand different strokes for different folks. I'm giving people a little bit, insight in terms of how I do things. But so the real question is, what has changed? And I'm saying, so getting into that larger buy signal, we had a major breadth thrust signal on January 13th on the close. I tweeted about this. A number of people did, but I was a little bit surprised at why everybody said this time is different, which they always say when these signals happen. That signal was when you get a 10-day better than 2-to-1 advancing issues versus declining on a 10-day average. Historically, this is a rare signal. The last time it happened, June of 2020. Anybody can study that, but the chart I posted has all the historical dates. Has a very good historical track record out 6 to 12 months. The reason for that, though, is that is measuring, it's almost like RPMs. And the analogy I've given before is if you and I are riding in the car and I stomp on the accelerator till it redlines, and then I take my foot off the gas, our momentum is still going to carry us much further down the road. And even if I put on the brake, I'm going to put on the brake violently after that much acceleration to slow us down. And that's precisely what we've seen following that signal on the 13th. If you remember, Maggie, the last time we spoke, I said, historically, the 200-day declining moving average keeps the lid on all bear market rallies. And if you study this from last year, say the Dow did it first, but where the major risk areas of the market, specifically Russell and S&P, over the last 2 weeks have convincingly broken above their 200s. This is a major character change.
I think we might have a chart of the Russell. I'm not sure. And that's important. Why, Mark?
The Russell, as I've said before, is a primary indicator for risk appetite. This is precisely why the Dow has just consolidated. And I think this is a net positive as well, because if the Dow had sold off while the Russell had rallied, you would basically say, well, I don't know that there's a whole lot of net flows going in the market. People are just going out the risk curve. The Dow has gone sideways while managers are going out the risk curve. NASDAQ and Russell are leading this advance right now. And if you look furthermore, the Russell and NASDAQ have not had more than 2 days pullback for the entire beginning of this year. That's what I would call a lockout rally, where the market takes off. And if you're not willing to be aggressive and buy, you're locked out, meaning it has left you in the dust. Now, I can talk about what I would be looking for sort of going forward and how I would think about exposure. And I want to be clear, I'm not just saying go limit long stocks. I am not levered long at this point. I am responsibly long and looking to get longer should things, play out, and conversely. If we start to see the same things that we had during the entirety of 22, where distribution, that's heavy volume selling, and markets pulling back on increases of volume, taking out some of these areas of support, I'm going to be waving the caution flag just as fast. However, like I said before, given a number of these technicals, I think you give these signals the benefit of the doubt and you start testing the waters, so we can go from there wherever you'd like to.
Yeah, I like that. Let's get a couple questions in because I think they're good ones at this juncture of the conversation. Robert asking, has Meta's jump distorted today's performance?
Well, I think in the overall averages, yes, but it's sort of, and let me be clear on mega cap tech. I don't think, and I've said this before and I'll say it repeatedly, you don't want to be looking at the most beaten down names from the last bull market as where to reallocate your capital. You want to look for new leadership, new ideas. I can get into the areas I'm looking at, but Meta is a name that is, a broken leader in my opinion. However, it is interesting that clearly everybody who was thinking Q1 earnings are going to be a disaster, that was already priced into the market. Or at least at this point, they're not as bad as many of the analysts had potentially anticipated. So the point, and Andreas made a really good point, I thought, saying that this has been a wildly telegraphed potential recession. Yeah. So if that's the case and the recession is mild, is it possible it's already priced in? It's very potentially. I mean, everybody last year in Q4 is basically just, there wasn't anybody you could throw a dart out the window and hit, a bum on the street saying, hey, we're gonna have a recession in middle to late 23. So to his point though, is it possible that businesses have already prepared for this?
Yeah.
Certainly possible. And the market may be telling you that.
And what have they prepared for? That's the other question. Have they prepared for a mild recession, a short one? Have they,
Well, and
this is
if the
where
crowd
this is
is
the unknown.
right, and if the crowd is always wrong, then either or the market likes to fool the majority, as I think Paul Tudor Jones famously said years ago. If that's the case in this case, then either we're going to have a really nasty recession, or one that is so mild that it's already priced in.
Yeah.
So either of those, again, you have to just keep an open mind. You have to be open-minded when you dig in with an opinion. This was the same thing, in 2020, nobody wanted to buy the market after the big break in COVID. And there was signal after signal, technically speaking, saying the market's telling a different story. By the time the economy reopened in mid-21, the market was not a buy anymore.
Yeah.
You missed the whole move.
I think it's recency bias, right? You're sort of,
exactly. Precisely.
Yeah. Which is why psychology matters. I want to slip a clip in because we're getting some great questions and I want to get to as many as possible. But I just want to round this out because if we see equities rallying, if risk is back on, what's the flip side or the other camp, which in my mind, talking to a lot of people, was energy, what were commodities, were healthcare. We have a question on that. I spoke to Rick Rule as part of our Looking for the Upside series. That interview's out on the platform, and he is very bullish gold. He thinks that that's one of his top picks. Now, he is a traditionally, his background is in commodities, but he's very bullish on gold. Let's have a little listen to why he is, and then we'll talk on the other side.
The weaponization of the dollar and the impact of negative real interest rates on U.S. government savings products, I suspect, will lead to a global lessening of the market share of U.S. Treasury securities among foreign holders, both as a store of value and as a system of exchange. I am not one of these, Maggie, who believes that some new mythical fiat currency or some cryptocurrency will dethrone the U.S. dollar. That isn't what I'm suggesting. I suggest that the U.S. dollar will be the primary medium of exchange in the world for at least 20 more years. But I think its market share will decline. And I think one consequence of that is that the market share of gold in international transactions will increase.
So, Mark, by the way, as I mentioned, that full interview is available on our website. You can hit a link. Hopefully, there's one in the chat or the QR code to find out how you can join so you can see both that and Andreas's Steno signals and all the other offerings we have. So, Mark, how are you thinking about commodities based on on what we're seeing right now and the fact that this does look different and the indicators are encouraging? How does the commodity story fit in?
Great question. I'm not a commodity specialist in that sense, but there are markets I still track. And the interesting thing, so I'll make a quick comment on gold and oil. And the way I would frame them is to say that gold right now, actually, the price action reminds me a little bit of the way oil acted at the beginning of last year, where if you look at the price action to start last year, say in the XLE, it was just clear the managers came in underweight and wanted more exposure. Where gold has sort of started the year trading that way. It didn't have a good day today. I would not be chasing gold here. I am bullish, not necessarily for the same reasons that Rick is. Energy looks like it is potentially selling off. I'm interested. I'm not long. Really, I had one energy name, I think, and I got stopped on that today, actually. So I think that this may be part of a rotation trade, but part of my larger bullish thesis would potentially be, if we're really broadening out in the rally, that even this pullback in energy should not sell off enormously, where maybe the oil and gas names potentially take a rest, other names come up, and then again the rally broadens and lifts all boats higher.
Interesting.
Gold, I will say this, and my general rule is when listening to someone like Rick Rule, who's been a specialist in an area for longer than I think I've been alive, is you close your mouth and listen. As I often like to tell my kids, it's pretty tough to listen with your mouth. So, and I think he makes some good points. I listened to that interview while I was doing some of my homework yesterday. But the one point he made was the idea that he's expecting, I think, potentially to see some flows into gold. That makes sense for me even from some of the conversations, and he was talking about out of sort of treasuries and some of these other considered more stable assets. That makes a lot of sense to me, just from a logical standpoint in terms of the pain we saw in the 60-40 trade from last year. Maybe managers go, look, why don't we go, I don't know, 59-41, you know, and kick a little money towards precious metals. And in some cases, you know, maybe it's a lot more than that. Right now, I would say gold's in a little bit technically. I'm interested to see how it looks like it wants to consolidate. Had a really nice run to start the year. And my rule in watching any trend, to my point before about a lockout rally, when a market, the best thing a market can do is stay overbought. It tells you there's still an appetite for that. And then generally those first pullbacks, consolidations tend to be shallower. So if gold just comes crashing back down, to me, it would either tell me that it's going to have to put in a larger base, or it may not be as strong as we think in terms of the flows. And again, flows are what ultimately drives all these markets. So if institutions are showing up and starting to allocate more capital towards gold, I think these calls for higher gold prices are all accurate. The one thing I will say that I don't like about gold is it does seem like there are a number of people calling for this. That again,
when everyone's saying the same thing, right?
But are they doing the same thing? So saying the same thing. Listen, there's no shortage of newsletter writers that have caught every turn in the history of the bull markets and made no money. Because they're, you know, if you pay somebody to write a newsletter, they're going to claim they nailed everything without ever actually trading it. So the real question is, are there flows coming into the market? Because you're not going to be able to stop. When the big boys show up to buy, prices have to move higher. And when they show up to sell, it's the same thing. So that's a market I'd be watching. And then particularly for me, I want to see how do the precious metal stocks trade. Right now, it's not screaming that strong, but the metal to start the year looks very constructive.
Those are great points, and that allocation, that reallocation, was what jumped out at me, and is in the takeaway we did. By the way, James did a very exhaustive on the end of that deep dive into, if you're interested, how you trade that, some of the actionable things you can look at or think about if you want to do that. So recommend checking that out. What you just talked about, I think, was very interesting when you're talking about consolidation. Lena asking, around the market bottom, would your indicators fluctuate for a period of time before you have conviction that a bull market is here to stay? So the dynamics of the turn. That's a great question, Lena.
Yeah, so it's a really good question. Just to be clear, I'm not a get the top tick or the bottom tick guy. I'm the guy saying, let's play between the 20s, because that's where I think the bulk of the money's made. There's nothing wrong, by the way, if your style's to trade turns and you've had success doing that, God bless you. But that's not how I do it. So by definition, I want to see how things come off the low. And what I'm saying is the RPMs and firepower that we've seen this particular rally in equities is far more convincing than what we saw anything last year. And further, this is what the most important point I would make is, what do we do from here? Or what should you look for from here?
Yeah, let's talk about that, because we're almost out of time. What should we look for?
Well, for me, the bullish scenario is twofold. The biggest thing that's been lacking is stocks that are trading near 52-week highs or in consolidations, breaking out and then following through from those breakouts. This week is the first week I've seen sort of a character change in terms of that dynamic. So what I would tell people to do, even if you own nothing, I would say don't just go wildly chasing something that's extended, because one of two things is going to happen if I'm correct. The market is going to stay overbought in the near term, and you look for then stocks that are coming out of consolidations, where prices have been moving sideways. And then again, if I'm looking for this rally to broaden out, breakouts should continue to work, and it will allow you places where you can use good risk management. And then the other scenario would be, eventually this market is going to consolidate, and that consolidation, so you selectively pick some names, like I said, individual names or areas where you think you have good opportunity, to grab a hold of future growth at a reasonable price, whatever your metric is there. But what I mean by risk management is where you don't have to just say, well, I'll put my stop at the lows last June and hope for the best. I think you can do a little bit better, because if this rally is really broadening out and going to last even to these breadth thrust from the 10-day breath thrust, if you study this, even the cyclical bull markets in the 70s, most of them started with a signal like this, and they lasted 6 to 12 months, and were definitely worth trading or investing for parts of those. Again, risk management being prudent. The other scenario, though, is if we get a bigger consolidation, does the rally broaden out, and do we start to see lots of consolidations, different groups, and things starting to continue to break out under the surface while the market marks time? That's the biggest thing. Too many people take their cues from the index in terms of what stock should I buy. And so I'm saying you look at both, but ultimately it's a market of stocks. So if the individual stocks continue to break out of consolidations and follow through on those breakouts, which has been exactly the opposite. All of last year, if you bought anything near the new 52-week high list, it was dead money going away. And talk to any manager who was even close to my style, and they'll agree with you. And I'm saying we're seeing a change in that dynamic. That dynamic should not only continue, it should potentially accelerate, if I'm correct.
Wow. So it's nice to have a bullish conversation, Mark, and that's my takeaway, that you are really feeling like a lot of things are lining up and giving you good signals, that this does feel different. It does have the potential to have some legs to it, especially when you're watching the Russell. You're going to be looking at net flows. I love that lockout rally. I'm going to remember that one. And so keep an eye on all the indicators you just mentioned, but it sounds like we're in for a run here.
Yeah, well, and the other thing I was going to point out is, listen, pullbacks should be shallower and on lower volume, meaning normally pullbacks in early parts of an advance are mid-single digits, say in the indexes, and just look at your own portfolio. If everything just starts coming crashing back down, volatility should also stay lower. The VIX has sort of broken lower. That is a healthy bull market advance signal. If you study, sort of the VIX as a contrarian indicator, when it's north of 25, generally it is tough sledding for equities. It's hard for the equity markets to trend in any meaningful way. So those are two big things to be looking for.
And we're gonna get a good test of this, because Amazon and Apple both trading lower in after hours trade. Apple missing on revenues. A lot of that may have been telegraphed. We're gonna have to listen to the conference calls on both of those. But again, as the final thought, your point about look for new leadership. The leadership that worked before isn't going to necessarily work. So we all have some homework to do, because you get the sense that people are still looking at those big mega cap.
Well, that's a really good point, Maggie. If tomorrow everything gets slammed, I haven't even looked at the tape yet to see what the numbers are and how bad those names are trading. But let's say tomorrow we consolidate, but the money rotates away from a mega cap back to some of these other areas. That's potentially bullish. To your point, though, if we just go risk off, that's going to be, batten down the hatches again. Volatility rises, as distribution starts to hit the tape again.
Yeah, it'll tell us what we need to know. Mark, such a pleasure catching up with you. Thank you so much. I know we didn't get a chance to get to all of the questions, but just roll them right up at 5 when Raul's doing his AMA. I've got questions. I want to put them in there, but I don't think I'm allowed. But I know it's going to be really, really fun. He's going to have a lot to say. So go ahead and just join us at the top of the hour and post your questions, and hopefully he'll get to them. But thank you all for joining us today. It was a great conversation. It's going to be a fun end to the week. We've got jobs tomorrow, if I'm not mistaken. Yeah, monthly jobs report, and another extended Friday RVDB. So get your questions ready. We're going to dig into it. I hope you'll join us then. In the meantime, take care and good luck out there.